Now the next question is at 9:50 Eastern, when ES broke down below the zone, was it a good idea to short when ES retraced back into the zone? So I don't think it's so much about retracing back, because when you say retraces back into the zone, the idea you're getting at is that this is like a pullback setup, and I don't think it's really a pullback idea. If you're taking this trade on the short side, which is fine, it's valid to take, it's really more of a false breakout idea, right? So the market's opening near resistance, it's made a pretty big run in the overnight session, and now we know that in order for that run to continue, we need to see a breakout, and we need to see continued upward momentum and broad market strength. So that's what needs to happen in order for the longs to actually get paid, or in order to justify the buyers holding their trades. And this ends up being a false breakout, similar to actually what we saw yesterday, except this move happened overnight. So you can see that the market establishes this range before the market opens, tries to break out, fails just a little bit, 3 ticks ahead of the initial resistance zone for today, and then actually breaks right back down. I don't think the zone is as big of a deal. I think the fact that it's a false breakout attempt is the pattern that warrants more focus, and that's the thing you want to give more weight to, because it's opening at a significantly high price, and either it's going to continue and put in a breakout, and if that's going to happen, then there are certain criteria for that. Sustained upside momentum, broad market strength, the other markets participating in the move, and then the price action itself should be supporting that idea and being bullish. But when you get this false breakout where you get a wide range bar, you try to go out of the overnight range, you can't, you fail ahead of initial resistance, you drop right back down, now that range expansion could happen to the downside. And anyone who bought in the overnight session can now be in a riskier position. That's why we talk about looking at the chart through the lens of market participants, having an idea of how the other participants in the market could be positioned. What are they looking for? What's their motive? And how are they going to respond if the market does X, Y, or Z? So over here, imagine that you have gone long on the breakout, over here, right? Or imagine that you have bought somewhere in this range, and you're buying and you're thinking, hey, this could retest, the previous day's high. It could go higher. Like there could be some decent profit here. So you put those trades on. But then you notice this consolidation, false breakout, followed by a breakdown. Well, that's going to kind of get you on edge, and you may decide to exit your position, right? People don't exit their trade just when they get stopped out, right? They also exit when the probability of the market reaching their profit target is severely diminished. So when you put in this false breakout followed by a breakdown, the likelihood of the market going up to those targets is now significantly impacted. And that results in people bailing on their trades, right? So one of the things I talked about in this morning's video was that the overnight looks quite bullish, right? And that's why our short-term bias was neutral bullish. It was really based on the overnight price action. And by default, we're going to give preference to long setups, right? But if in real time we start seeing indications that are telling us that sellers are regaining control, so if we start seeing bearish signals in real time, then even though that's the low odds scenario, right? Even though that's not the high odds one that we're focused on, even though it's the low odds scenario, if it triggers, it can result in a bigger move going the other way. And the reason for that, the principle behind that, is that when the high odds doesn't play out, it catches a big group of participants off guard, right? So you get a situation where you essentially have trapped traders, where people just want out. So who is going to get trapped? Well, anyone who bought yesterday and is still holding their trade, anyone who bought in the overnight session and is still holding their trade, anyone who bought this breakout, and anyone who bought immediately off the open or even ahead of the open in anticipation of upside movement is going to be caught on the wrong side. The most at-risk group is going to be the one up here. After that, it's going to be these guys. After that, it's going to be anyone who bought at the lows and anyone who bought, down here in the overnight session. And step by step, all those guys basically get taken out, right? Because again, they're not just going to continue holding it as long as they're not losing money. It's like if the probability of the market going to my target is not that high, then why bother holding the trade? Let's take whatever we can get. Let's take the profit, right? And again, put yourself in the shoes of someone who bought yesterday, someone who bought here, right? So just think what you would do if you had bought here in the overnight session and now the market like slices right back down. Would you continue holding your longs, or would you, just take profit on this little bounce back up and just get out at break even or small profit, small loss, whatever, right? And then, the next move comes and now more participants are caught on the wrong side, right? So, of course, they're going to get out too. And these things can be prepared for, right? I mean, it was covered in the morning video. And it was a lower odds scenario, right? But when the low odds scenario plays out, usually you end up getting an even bigger move, which means there's actually even more opportunity when the low odds scenario plays out, right? So one perspective is, the high odds didn't play out. That's bad. Like, why didn't you predict this thing correctly, right? The other way to look at it is to understand that you have to be open to both scenarios. That's exactly why we suggest putting together a high odds scenario and a low odds scenario. And understand that when the low odds plays out, it's not a bad thing. It's not poor planning. It's not, poor trade plan development. It's just what the market did. And if you've prepared for the low odds and you understand that, hey, when the low odds plays out, there's actually even more opportunity, well, then it's a good thing that the low odds played out, right? It's not a bad thing. And if you remain flexible as a day trader and you're open to both sides instead of trying to predict and getting locked into just a singular view, then you can actually get more aggressive on the short side when the long side doesn't play out. Now, it's not going to be like this every day, right? Some days the market is not really set up in this way. The market may just be balancing overnight and neither side might have edge. So it's not going to be like this every day, but in scenarios where, there has been significant movement overnight and you're opening near resistance and you're kind of at this inflection point where, one side has to press to continue being in control, that's usually where you get this type of setup. So in terms of, shorting up over here, I think if you understand that, then the short makes sense. And it's not a mechanical idea of zone didn't hold, let me short zone, right? You have to understand the bigger idea behind it in order for the short idea there to make sense. Otherwise, the takeaway becomes, anytime a zone doesn't hold, I'm going to fade the first move back into it and expect a bigger move. That mechanical stuff doesn't work. You have to understand this stuff at the deeper level and understand all of this detail and how the market is set up and why are we expecting this, and if this doesn't work, why do you think the market's going to go big the other way, right? And then the day makes sense. Then it's not confusing, then it's not surprising, and then you can take an aggressive short when the market pops back up, right? So I mean, this move really kind of launches from this area, right? So we get a move down, we pop back up, and then we get another move down. So when the market pops back up, even though it's technically considered an aggressive short, because you understand that principle that, hey, look, if the low odds is playing out, which I think once the market broke down into the pre-market support, it was pretty clear that the low odds was playing out. Now you can get aggressive on the other side. And you view it as a very good thing, that the low odds is playing out. It's not going to happen that often, right? Usually the high odds will play out. But that's exactly why when the low odds plays out, it ends up being such a big move. If it happened all the time, then it wouldn't be low odds, right? So I think when you look at it from that perspective, then things make a lot more sense. And then you don't think of it as, oh, it's a zone and I'm fading a zone. No, you're thinking, hey, high of day may be in, right? So let me use the high of day as a stop, take it, 5-6 points below that. And even if I have to use a big stop, that's okay, because I know the market can go big the other way. So it's a different way of thinking about it. It's not as mechanical. It's not as simplistic. But that's the stuff that works long term.